go around the room, introduce ourselves for the record.
Good morning, everyone. Rosemary DeBellis, designee for Police Commissioner Bratton.
Barry Dennis, SAS, consultant to the fund.
Dan Torelli, PBA, proxy for Al Paserno.
Joe Alejandro, PBA designee for Patrick J. Lynch, Mubarak Abdul-Jabbar, and John Puglisi.
Chris McGrath, PBA by invitation.
Bob Ganley, SBA designee for Ed Mullins.
Lou Carabetta, designee LBA for Lou Turco.
Chris Monahan, CEA designee for Roy Richter.
Kenny Sparks, DEA designee for Mike Palladino.
Karen Paxtis by invitation, DEA.
Christopher Pogg, Controller's Office by invitation.
Brian Cook, Comptroller's Office by invitation.
Tatiana Pawlicki, Comptroller's Office by invitation.
John Mercerberg, Controller's Office by invitation.
Yvonne Nelson, Controller's Office by invitation.
Martin Gans, Controller's Office by invitation.
Scott Evans, Controller's Office by invitation.
John Dorsett, designee for Controller's Training.
Antonio Rodriguez, designee for Finance Commissioner Jackie Huff.
Carolyn Wilbert, designee for Mayor de Blasio.
Bob Sansky, State Pension Fund by invitation. Kevin Holleran, Pension Fund by invitation.
Justin Holt, Mayor's Office, invitation.
Alex Donier, Comptroller's Office by invitation.
Neil Messing, Comptroller's Office by invitation.
James Delgadio, Controller's Office by invitation.
Evan Knox, Controller's Office by invitation.
Inga Van Eisen, Law Department by invitation.
Nicole Giambrisi, Police Pension Fund by invitation.
Okay, thank you. Scott?
Okay, we got a big agenda today. We have the whole band for you to go through the quarterly results. I'm going to kick it off quickly to Martin. He's going to go over the total fund, and then we're going to start with Brian Cook on ETI because Brian's got to go, and then we'll go back to the top of the book, go through all the asset classes, and then Martin and I will give you the usual quarter or monthly stuff at the end. So Martin, why don't we start?
So before I start, this is the book we're looking at, the quarterly report. I have one extra if anyone needs it. Let's go.
Share.
No. There you go. I got it. Okay. Good morning, everyone. So the quarterly report that we're referring to is the quarter ending September. We talked about September last month, but to remind you, the quarter ending September was a volatile quarter. July, August, and September was down, up, and down. And then we'll talk about October a little bit later, which was a strong month at the second half of the month, and November to date November was a strong month, so we're back at record highs. By the time in September, it was very volatile. And in fact, if you turn for risky assets, so if you turn to page 8, for the total police pension fund, you will see on the left, and the first two columns on the left for all of the pages, you should note, are the same because the fiscal year to date is the same as the first 3 months. The return in dark blue was minus 86 basis points behind the benchmark of minus 38 basis points. I'm sorry, minus 86 versus minus 38. That is primarily due to the fact that the Russell 3000 was roughly flat, EFA was negative, Core Plus Live was slightly over flat line, and high yield was down about 1.5% for a slightly negative return. You'll see the October numbers in just a minute. Those numbers are much better, and you'll see that the numbers start improving. And certainly we'll give a hint of November as well. So we are, and we'll tell you where we are, what our estimates are, but they're above what you see here. The last 12 months, you see our double-digit returns behind the benchmark, but the numbers, like I said, from October and November were strong numbers. So for fiscal year where we are today are much better than these negative returns. They're now positive returns. Unless there are any questions on that, I'm going to turn it over to ETIs.
Thank you. If you jump to page 51 in the book for the overall ETI program, for the past quarter, the ETI program's up 16 basis points. And for the fiscal year to date, we're happily up 369 basis points. We've outperformed our benchmark for all ETI investments. I do have one correction for you in the weeds of this book. Page 74. Access RDC. Our consultant updated the numbers last week after you've already gone to printing. So the 1 year trailing number, it says 3.96, it should be 3.91. The 3 year trailing is 2.77, it should be 2.75. And the 5 year trailing should be 3.90. Oh, sorry, that's fiscal, that's the 1 year, the 1 year, not the fiscal year to date. Thank you for that correction, Chris. That's why you keep swearing. And then if you want to look at the number of housing units we produced in this book, starting on pages 6 and 7.
I have one extra copy of the.
And I'm happy to give up mine. The PPAR program, which is our long-term loan program, we outperformed our benchmark by 34 basis points during the third quarter and 752 basis points over the last fiscal year, so we're doing pretty well. We've created or preserved 605 units in the third quarter, and we committed an additional 163 units, which will be coming in the coming years. On page 8 and 9, we have the AFL-CIO HIT program. They outperformed their benchmark by 6 basis points in the third quarter, and they're up 45 basis points over the last fiscal year. On page 9, they invested $5 million in a Bronx Mitchell-Lama program to help preserve 766 units. And lastly, Access Capital Strategies on page 11 outperformed its benchmark by 26 basis points in the third quarter, 107 basis points over the last year. And in the third quarter, they invested $280,000 into 8 single-family homes. That's where we are.
When you say preserve units, can you explain that?
Yes, so the programs are all designed to either create new or preserve affordable housing units. Each program is set up slightly differently. In most cases, when they're preserving an affordable housing unit, it's an existing rental building that has agreed to enter with HPD or another city agency to extend its affordability for an additional term. In doing so, they can get not only city money, but say Sunny Mae Insurance and qualify for our loans. So it preserves the affordability in the long term. And I should note the AFL-CIO HIT is probably slightly different in that it's taking large Mitchell-Lamas that are in other large housing complexes that are already in the affordable housing market and helping improve them. Often used as a supplemental to the J51 from what I can tell, which does preserve affordability.
Any other questions for Brian? Thanks very much, Brian.
Thank you for the consideration.
Okay, why don't we then go to the top of the book, which should be equities, right?
Well, before we do that, I want to look at attribution. So
Oh, sorry.
pages 9 and 10, so if you take a look at page 10, this is the identical page that you saw last month. We're going to go through October, so let's wait a little bit till we go through October, and we'll say where we are versus allocations up to the minute, instead of going back to where we were September 30th. Attribution starts on page 11. The summary for the quarter, year, and 3 years are on pages 11, 12, and 13, with a summary on page 14. So we can take a look on page 14. For the quarter, because the returns were fairly low and modest on either side of flat, for the allocation effect, the overweights and underweights that we, as you know, have been taking down some overweights, didn't have much of an effect, but manager performance on the bottom did have an effect on the negative side on domestic equity and private equity. With a 1 year number on the allocation effect, again, the overweights and underweights, that did have a strong effect. as well as partially for the 3-year period. The biggest effect on the 3-year period was in the beginning of that 3-year period, the overweight to cash, which hurt in a rising market, as you see, minus 43 basis points. For the manager effect, how managers did versus the benchmark, similar issue for the longer term. So looking at 3 years, private equity dominated the negative return total. And for the 1 year, U.S. equity, non-EFA, and private equity were all, on negative side, were offset by positive returns by managers in Core Plus 5 and high yield. We'll go over how those numbers look in just a little bit. So how did police do versus other public funds? That's shown on page 15 and page 16. This is large other public funds defined by funds greater than 10 billion. So if you take a look at page 15, for the quarter, it was right, the minus 86 basis points was exactly at the median of returns. And for the 1 year, 3 year, 4 year, and 5 year, and in fact the 7 year number were either at median or in the second quartile. As you see those numbers, second quartile is better than the third quartile. The police fund is the blue dot, and the policy benchmark is the red symbol. Before we go to equity performance, are there any questions? Yeah, I'll turn it over to John.
Okay, I'll pick it up with U.S. equity on page 19. Total domestic equity underperformed by 92 basis points for the third quarter. This was primarily driven by the overweights, the small and mid caps. The small cap Russell 2000 returned a negative 7.36% for the quarter, and the S&P 400 mid cap was down 3.98%. And that was in comparison to the larger cap S&P 500, which returned a positive 1.13%. Moving on to page 21, we see that the small cap active composite was 10 basis points below the Russell 2000 index. And of the 6 active managers in the composite, 3 beat their benchmark and 3 underperformed. Turning to small cap passive, page 22. The small cap passive composite was ahead of the benchmark by 22 basis points. And this outperformance really occurred because small growth did better than small value, and police has more money in small cap passive growth than in small cap passive value, and that's to balance off the active part of the small cap portfolio where we have more value managers. Turning to page 23 for the mid cap managers, the active manager was slightly better than the index. Turning to page 24, mid-cap active. The mid-cap active composite was under the benchmark by 143 basis points for the quarter. Of the 5 active mid-cap managers, 4 underperformed for the quarter and 1 beat their benchmark. So the 3-year returns are well ahead of the benchmark for this group of managers. And then turning to page 25, the mid-cap passive account. Was ahead of the index for the quarter and is close to the index over the past 3 years. Turning to page 26, the Russell 1000 active composite was within 30 basis points of the benchmark for the quarter. And on page 27, the passive Russell 1000 composite also closely tracked the benchmark. On page 28, you can see the Russell 3000 passive account also closely tracked its benchmark as expected. And then finishing up in U.S. equity on page 29, we see that the managers of emerging managers composite was ahead of the benchmark for the quarter by 79 basis points. Does anybody have any questions on the U.S. equity portion of the report?
Questions for John?
If not, I'll hand it over to to Tatiana to talk about the non-US equities.
So I direct you to page 31. And this is going to be your developed market returns versus the MSCI EFA index. Returns slightly outperformed by about 34 basis points. Value actually outperformed growth, given the market and more sort of appetite for risk rather than quality. If you look over on page 32, that shows you how your developed growth guides did. The two in the portfolio are Bailey Gifford and Walter Scott. Bailey slightly underperformed the overall EFA index, and Walter Scott was actually up 200 basis points. I wanted to note that given its underperformance last year. That was pretty substantial. If you look at page 3, that's your developed value. That's Causeway and Spruce Grove. Both outperformed, but Causeway was the shiner by outperforming by about 2.6%. If you look at page 34, small cap EFA struggled both in the market and in your portfolio as the active managers underperformed by about 96 basis points. Given the high amount of active management you have, it's about 90% active, 10% passive. We'll move through the passive slide to page 37. This is just one manager. It's a small allocation, but it's active. It's Generation, and outperformed by about 88 basis points. I'll turn your attention to page 38, which is emerging markets.
You were on page 37.
Yeah.
What are the managers that we have on?
Just Generation is the last one that you guys have. There's only one manager.
Okay.
So if you look at page 38, this is total emerging markets. Outperformed the benchmark by about 43 basis points. That was driven by your 4 active managers, Bailey, Eaton Vance, and Acadian, who all outperformed. DFA underperformed. And that's basically it. If you have any questions, let me know.
Thanks, Tatiana. Yeah, that rebalancing to Walter Scott, is a good example of paying off. It was Tatiana's judgment, Barry's judgment that Walter Scott was a keeper. They were terrible performance, and we actually gave them more money as part of the rebalancing program, right into the jaws of their underperformance. So if you do that enough times, and you're right that the manager's going to continue to put together a decent track record, you're going to help your performance by having that discipline. So this time it worked out. Doesn't always work out, but we'll of course draw attention to it when it does. So let's move to the next asset class. Is that back to you, Martin?
No, it's
Neil?
a bond, REITs.
Oh, REITs.
What's the next one on the
REITs.
REITs? I'm sorry, Yvonne. Page 39.
Right. Okay, so we have a global passive REIT portfolio at REITs, and at the moment it is keeping track, slightly underperforming its benchmark. And also for the fiscal year to date.
Yvonne, you got to speak louder.
Oh, sorry. In the near term, for the trailing 3 months and for fiscal year to date, our passive REIT portfolio is slightly underperforming the benchmark. However, for the trailing 12 months, we are outperforming at 6.65%.
Good. There are no questions on REITs. We'll move on to hedge funds. Neil?
Yeah, so hedge funds, I'm probably going to repeat exactly what I said last quarter, and I expect to repeat that probably for the next few quarters. This chart shows you, is a great way of showing you the evolution of the hedge fund program. You have the most recent quarter in the fiscal year to date as the first 2 charts, the last 12 months, and then the entire hedge fund since inception. And if you remember, in the beginning we were out of balance in the hedge fund program, and more recently, over the last 12 months, we are now in balance, or certainly more in balance than we were when we first started, and this chart shows this. So initially when we were out of balance, we were outperforming one benchmark but underperforming another. Now that we're in balance, over the last 12 months and over the last quarter, you can see over the last 12 months we're outperforming both benchmarks. Over this quarter, we're outperforming the hedge fund composite index, but underperforming so far the T-bills plus 4% for the year. And like I said, probably over the next few quarters, I'm going to be I expect to be saying the exact same thing here. Now that we're more in balance with the hedge fund portfolio.
Questions for Neil? Thanks very much, Neil. Let's go to Martin in fixed income.
Yes, so as previously discussed, this was the quarter ending in September where volatility was reintroduced to the capital markets, and it shows up in the returns. Volatility generally is an opportunity for managers, as prior to volatility increasing, lesser securities with lesser expectations were treated the same by the markets as better securities, so it made it difficult for managers to be rewarded for picking the right securities, but this was the quarter where that started. If you take a look on page 42, you see where the dollars are allocated on pie chart, and half the portfolio is in the traditional 4+5 program. That program is further broken down on the next page with the three sectors. You see that the two largest sectors are the mortgage and credit sectors, shown in yellow and green. I draw your attention to the chart below that, the under-overweight. This is consistent with what we've had for some time now, where we show an underweight to the government sector because of the low yields and high duration, and an overweight to the spread sectors. In this particular quarter, where rates simply went down, the highest absolute returns was in the Treasury sector, so that did not help. And in addition, because of the volatility of returns and spreads widening out a bit, the returns were negative. When I say spreads widening out, what I mean by that is that for most managers, what's in the portfolio are treasuries and then agencies. Most managers will overweight agencies. Agency spreads widened for that quarter. You'll see that reverse the next quarter, at least so far for the quarter. And that's why they underperformed. However, of the 15 managers, 11 of the 15 managers outperformed for the quarter, and for the year, 12 of the 15 managers, and for the 3 years, only 2 underperformed, again, both in the government sector. So how did the total portfolio look for the 4+5? On page 44, you see that. Very modest returns. The returns were 25 basis points, 3 ahead of the benchmark. For the year, relative basis, very strong, over 60 basis points ahead, and over 5.74%, which is above the yield to maturity, which means that spreads compressed and yields went down, so duration helped. All the time periods shown, the returns were ahead of the benchmark, so managers did well. And on the bottom part of the page, you'll see that the risk, as measured by standard deviation, is below 4%, which means that volatility was low except until the last quarter, so that should start creeping back up. When I say creeping back up, it's not to equity levels, but to maybe perhaps 4 or 5%. Still very low. On the next page is progress, which is our emerging manager program. It was roughly flat for the quarter and well ahead for the 1-year period. Tips will be, we're going through a search process right now, and you'll see for the quarter on the left, the returns were negative by 2%, and they were exactly the same as the benchmark. And for the 1-year period, they were slightly positive, virtually on top of the benchmark, 5 basis points behind. And for 3 years and 5 years, right on top of the benchmark as well, slightly ahead of the benchmark. These numbers, with our active managers, did have an impact in our upcoming recommendation that you'll see from us in we hope next month. High yield, because of spreads widening out, managers underperformed, so they held on to the bonds that they liked. But because ETFs and other investors, non-economical sellers, sold what were our managers considered to be good investments, for the quarter, the returns were negative versus the benchmark by 38 basis points, but you see for the year was ahead by 58 basis points. The most defensive managers did the best, and especially in the month of September, not necessarily for the quarter because of July. and that's what we expect. So the program worked as expected for the longer term periods. The returns on an absolute basis are good, and the returns on a relative basis are good. Bank loans did what they were supposed to do. They were supposed to diversify the high yield portfolio, and that's exactly what they did. All three managers outperformed. While it looks like flat line, just 4 basis points, you can compare that to the page before, where you had negative returns. And for the 1-year period, we do not have a longer term record. All three managers outperformed by 66 basis points. Convertible bonds, we've been saying this for a while. You see the longer term numbers, the 3-year, 5-year, and 12-month number, where the managers underperformed the gray bar, which is the overall index, and that's because the index is an imperfect index, but they outperformed their individual benchmarks. And we've been telling you that when the market goes down, that will reverse, and sure enough, you see in the quarter that's exactly what happened. So over a cycle, that gray bar should come back to what the managers look like, but during a bull market, it will get away from them, but it reverses out as you see in a bear market. Opportunistic fixed income on the next page did very well. The program is working as expected. And those are some of the strongest returns that we have anywhere for the quarter. Next page is ETIs, which was already gone through. So unless there are any questions, we'll move to the next item.
Questions for Martin? Thank you. Excellent. Why don't we turn to, who's next? Private equity?
So good morning, everyone. I'll be leading you through your private equity report, and we're back in the large agenda package, and I'll be starting on page 25. Give me 1 second to get there. And first we'll look at some of the quarterly highlights. I'm not going to spend time on the cash flow activity bullet because we will come back to this in just a minute. So with the recent portfolio activity, the second bullet, I just want to talk about the key takeaway here, which has to do with the continued increase of your portfolio valuation, net of cash flows, both quarter over quarter and year over year. Your portfolio's valuation increased 3.2%, or $67.4 million, quarter over quarter, and 17.6%, or $325.9 million, year over year. Next, with regard to some of your new commitments to the to the program, police closed on $140 million in new commitments during the quarter, $80 million to Arden Secondary Fund 6, and $60 million to Crescent Partners 3. And then subsequent to the quarter end, the plan closed on an additional $98.5 million in commitments to 3 managers. So that's the update on your recent commitments. If you'll please turn with me to the next page, page 26, where we'll look at your active commitments and performance. As of June 30th, private equity represented 6.4% of total Police plan assets relative to a 7% target, with a market value of approximately $2.17 billion. This slight under allocation relative to your target is largely driven by the run-up in U.S. public equity markets, and second, to just strong portfolio distributions over the past 2 years. So looking at the performance summary table, you can see that as of June 30th, you had $4.09 billion in active commitments across 100 managers, 160 funds, with a market value of $2.17 billion, unfunded commitments of $1.37 billion, resulting in a total exposure of $3.55 billion. Looking at the bottom of the table, you can see that the portfolio's since inception net IRR remains steady at 10.6% from the prior quarter end, with the TVM, total value multiple, standing at 1.37 times. If you'll turn with me to page 27, the next page, here we will look at your performance on a vintage year basis. And what you'll see is that the system posted very strong returns in the 2001 to 2003 vintage years when compared to the benchmark period. This was largely driven by strong performance from some of your early commitments to large buyout and secondary managers. 2004 to 2008 commitments, however, have generally underperformed the benchmarks, and this is largely as a result of the difficult vintages investing in the years leading up to the financial crisis, but also due to an over-diversification of commitments. The good news, though, is that if you look at some of your recent commitments in the 2010 to 2012 vintage years, we are starting to see very strong results in line with and ahead of the benchmarks. If you'll please turn with me to page 28, the next page. Here we'll look at your portfolio returns presented over various time periods against the program's public market equivalent benchmark. That benchmark is the Russell 3000 plus 300 basis points. And since inception, you'll see that the portfolio generated 10.6% net IRR, lagging the program's benchmark though by 250 basis points. On a one-year basis, the portfolio generated 17.2% net IRR, and while strong on an absolute basis, this does, however, trail the program's benchmark due to the continued strong performance of public markets during the quarter. It's worth mentioning that this 17.2% figure represents a 530 basis point increase when compared to the portfolio's one-year return as of 1 year ago, June 30th, 2013, where the one-year return was 11.9%. So we have seen some significant uplift in the one-year number year over year. On the bottom of page 28, you'll see the portfolio's performance broken out by strategy and sub-strategy, and you can see that large buyout, secondary, and growth equity strategies continue to outperform. And then if you'll please just turn with me just a couple more slides on page 30. You can see that the portfolio remains diversified by strategy, with buyouts representing the largest exposure at 58%. And we expect this number to continue to increase as we source and allocate capital to high conviction managers, two of which we will be meeting with later today. On page 33, this is where I wanted to get back to your cash flow activity. On the top of page 33, you will see a summary of the portfolio's quarterly cash flows through June 30th, 2014. And what you'll notice here is that the portfolio has been cash flow positive to please 8 out of the last 9 quarters. And this demonstrates the portfolio's self-funding ability as it continues to mature. The last slide I'd like to draw your attention to was on page 35, to just look at your geographic exposure at the portfolio company level. And based on current exposed market value, North America represents the largest exposure at 80%, with Europe at 16% and 4% to rest of the world. So that concludes my prepared remarks, unless there are any questions.
Questions for James? Thanks very much.
Great. So moving on to the real estate highlights for the police portfolio for real estate in the large book, page 43. The page numbers are obscured, so I'll refer to the page numbers at the bottom, but essentially I'll be staying for the most part on the first page. And just some comments on the market. So the U.S. continues to lead the real estate recovery worldwide, followed by Europe. Domestically, real estate has benefited, of course, from the low interest rates, great access to financing, and we see this in higher transaction volumes. On a global basis, it's expected that commercial real estate transactions will reach $700 billion at the end of this year. That'll be a 20% increase in the amount of activity of properties changing hands. As a result, investors can expect that yields are going to be compressing, meaning prices are going to get higher for properties, especially in gateway markets like New York City, Boston, San Francisco, and D.C. But with debt being so readily available, investors are also stretching for yield, looking at different markets such as Austin, Miami, Seattle, and other secondary markets that demonstrate strong growth prospects or have a tech emphasis. Also, in terms of the dynamics in real estate, demand and supply, vacancies are decreasing, which gives a downward pressure on supply, and therefore demand continues to move up. These are all great metrics for a real estate expansion. And what does that mean for the police portfolio? Again, values are moving up. The market value for the real estate portfolio as of the second quarter is $1.2 billion. And year over year, that's about a 23% increase over where we were last year at $965 million at that quarter. So let's take a look at the performance, which is on the first page down on the lower right. you'll see that the police portfolio is indicated in the darker bars. The lighter bars reflect the benchmark, which is the NFI Odyssey plus 100 basis points on a net basis. In terms of our IPS and what the program benchmark is, we're focused on the 10-year, which police delivered a return of 6.9%, and the benchmark is 7.2. So we're slightly under our benchmark for the 10-year, but of course that incorporates all the investment activity of the police portfolio, including those legacy investments before the crisis. The good news is, of course, if you kind of bear all the way over to the left, with more recently the quarterly performance at 4.4% compared to the benchmark of 2.9 for the quarter. And the news gets better in terms of the 1 year. There's an outperformance of 400 basis points, with police delivering close to 17% compared to 12.9% on the benchmark. Similarly, for the 3-year, police delivered a 14.4% compared to the benchmark of 12.5%. So as we kind of look into this performance, particularly post-GFC, we recognize the fact that we started making investments. There was a temporary overweight, as you recall, to non-core managers because we thought that they could deliver the alpha to capture the distress that was in the market after the global financial crisis. Those non-core managers, as you know, have an investment period of 3 to 4 years. And what we're seeing in the near and the midterm, we're seeing these managers working hard to stabilize those investments, bring them to market, whether they're exchanging hand privately or if you have some managers that are issuing IPOs, and we read in the papers about IPOs for Hilton and extended stay. The time is right to exit these investments, and that's what you're seeing, that our portfolio is driven by rising values and appreciation. So just to move over to the left side of page 1, just to kind of give you a sense of what's going on, a snapshot of the second quarter. The real asset allocation is 6%, as you know. That equates to about $2 billion. In terms of the value of the real estate in the ground, that's $1.2 billion. We talked about that. In terms of commitments, we have some commitments that are unfunded at this point at about $280 million. And so the police exposure to real estate as an asset class is $1.8 billion. And we're doing that through about 52 investments at this point, through 38 managers. In terms of how the portfolio is constructed, you're aware that we have core plus strategies, core plus strategies, as well as non-core opportunistic strategies. For the most part, we try to keep that within a range of 40 to 60%. As I mentioned earlier, right after the global crisis, through our annual plans, there was a temporary tactical overweight to non-core. We're no longer following that pattern, but as I mentioned, because of the investment period, we're seeing the results 3 to 4 years out. As it relates to new investment activity, there wasn't anything going on in the second quarter, but subsequent to the second quarter, as you know, police approved a commitment to Almanac Realty 7 for $50 million. And also we upsized our commitment to Blackstone Europe 4 for an additional $22.5 million. The following pages kind of show you how we diversify the portfolio in terms of risk, investment strategy, property type, and also by manager. In terms of our compliance with our investment policy, there's a report card, if you will, on page 7, and I'll be happy to take any questions.
Okay, hearing none, we have Evan talk about infrastructure.
Great. This is page 55 in the big book. So police have committed $160 million overall to infrastructure. Approximately 10% of that, or $15.6 million, is drawn, which is double from what we reported a quarter ago. Program IRR is at 10.5% versus a benchmark of CPI plus 4, which is at 6%. Obviously, this should be taken with a bit of a grain of salt, considering the early nature of the program. I will say that existing investment is performing in line with expectations, though, and has been cash flowing as expected.
Okay.
Any questions? Great.
Thanks, Ev. He gets our award for brevity. I think that's, Martin and I want to talk about October performance, give you a little snapshot of November, mostly Martin. So why don't we turn,
We're now in
to the
the
big-
color book. We have lots of extra copies. Anyone need anything? We're good? So I mentioned earlier in my remarks that volatility returned to the market, and we'll show you some evidence of that in the economic charts. When we were waiting for this to happen, we didn't quite understand why it hadn't happened yet, but it now has started to occur. The U.S. economy is ahead of Europe and Japan. Europe and Japan are teetering on recession or not. U.S. economy, while it's growing at a lackluster rate, but it is growing. And so we are, not only is quantitative easing program over, the Federal Reserve bond buying program is over, and they have $4 trillion of assets, but the next move is likely for rates to go up, meaning short-term rates to go up, and then logically long-term rates, which the market dictates, will follow suit. In the meantime, rates on the way up have gone down. On pages, if you turn to pages 15 and 16, you see the dollar compared to other currencies. And this is a 5-year chart on page 15. And finally, the dollar is now strengthening against other economies. When you have an economy that's stronger than other economies, such as the U.S., when you have an economy where interest rates are either higher or likely to go higher than other economies, it draws capital to that economy, and by supply and demand rules, that dollar, that currency should appreciate, which has finally happened. It had been a bit of a conundrum as to why it had not appreciated greatly against the euro, whereas Euroland was in the doldrums and continues to be so and several years behind, but that has finally started to show. So on page 15, the basket of dollar versus other currencies is near a 5-year high just off of it. And on page 16, versus the euro, you see it's finally starting to, the euro is finally starting to decline. It was in the 130s for several years, and it's now in the low 120s. There are predictions that it'll be near par. Time will tell, but what that does is that if the euro declines, it makes their exports more competitive. But unfortunately, on the other side, it makes people living in Euroland, it makes their cost of living higher. For the U.S., on the flip side, it makes our exports more challenging and more expensive, but it also means that the cost of living is now lower in the U.S. I mentioned volatility, so if you turn to page 18, you'll see the chart all the way on the right. Since quantitative easing, the latest plan was announced several years ago, the volatility as measured by the VIX, which is versus the S&P 500. There are other volatility indexes, but this is the most liquid and most widely quoted version. The white line was in the low teens, and in fact bottomed out at near 10, which historically is very, very low. You see the spike up towards the right. That is when the markets in late September and early October were concerned, all of a sudden started paying attention. These concerns were always there, but the market had ignored it. Once quantitative easing was over and the prospect of rising rates were there, the market started paying attention to other fundamentals such as geopolitical risks and other economic risks, and the volatility index more than doubled. You'll also notice at the very end, towards the right, it came back down. And that's the second half of October and November. One of the Federal Reserve Board governors made some comments that were perceived to be dovish, that if if the economy slows down, or they're effectively saying that there are still options to continue QE if necessary, which buoyed the market and gave it sort of put a bottom on it at the very time when the market was going down 8-9%. Cumulatively, it bounced back and is now at record highs. So the volatility increased substantially, but came right back down once policymakers made it clear to the market that they would act if necessary. The 10-year Treasury is on page 20, and it hasn't changed much since we printed this a week ago. The 2.3%. There was a period of time, it doesn't show up here because it was intraday within the last month in the panic in early October, where the intraday 10-year Treasury went below 2%, was about 185. It ended the day back at about 213, but there was a bit of panic in the market when there was concern over QE and macroeconomic events and geopolitical events. But the market certainly has stabilized since then. While we are expecting long rates, this represents long rates to go up, but comparatively speaking, when you compare U.S. sovereign debt treasuries to, say, Spain or Italy, which are much lower quality and have similar rates, that doesn't quite make sense, and therefore money is flowing in to U.S. Treasuries, which is keeping a lid on the rise in the price, because investors are looking at higher quality and also looking for yield across the board, across the globe. And this is one of the areas they can find it in sovereign debt, in high-quality sovereign debt, when you have record lows in Germany and in France below 1%. Japan is below 0.5% for 10-year treasuries. So this is an area that's that while we expect rising rates, every time rates start rising, it's an opportunity for investors to put money to work at a high-quality sovereign debt treasuries. Next page shows investment grade and high yield. There was a spike up, as you see, all the way on the right, just like there was with the volatility in the treasury market. Spreads on the red, which is high yield, spiked up to near 500 basis points, and then came right back down towards the end of October and into November, back to the trend to where it was similar. It's hard to tell on the investment grade side for which is shown in blue. All this means is that there was opportunity for managers to buy things that were effectively on sale by 5 or 10% in some cases that were perfectly credit-worthy, but because spreads widened at that time period, that will show up in the coming months as those yields get incorporated into the results. Turn several pages. If you take a look at page 25, this shows in white the U.S. markets over the last year, and in orange and yellow shows developed non-U.S. markets and emerging markets, and you can see there's a fairly large divergence. This divergence has been going on for a while, and that's primarily because the U.S. economy is stronger than those other economies. IFA is teetering on recession, and so those markets are roughly flat, whereas Russell 3000 U.S. markets have done quite well. We show what the October numbers were for the asset classes on pages 27 and 28, this page here, towards the middle of the book. And as I mentioned to you, October was a good month. This is past the September quarterly. We just went through the quarterly, which was flat to down. So October was a good month, and towards the end, first, it's really a tale of two parts of the month. The first half of the month was when the panic was in there, nearly 10% decline cumulatively, and then the markets calmed down in the second half, and more than calmed down, but near record highs. So it made up the losses. So the 1 month number for Russell 3000 was 2.75%. And the 1 month number for IFA was down 1.45%. That's in the next column of numbers. That's not because the stocks went down generally, but that's because of the, as I mentioned before, the currencies. When the IFA, when the euro currency weakened against the dollar, the prices of the stocks, even if stocks went up, in U.S. terms, the overall return was negative. Emerging markets went up for the month 1.18%, and most of the numbers that you see here are positive. So we expect that the October returns should add another, say, 0.5 to 1% for the portfolio. Core Plus 5 went up by 1.17% because, as you saw in the previous chart, interest rates went down and so prices went up. As a hint for November, November was a continuation of October. November was a very good month in the capital markets for risky assets. Russell 3000 was up another 2.4% to a record high. EFA was actually up 1.4% as currency stabilized. Emerging market debt was down about 1%. Core Plus 5, as rates went down, was up nearly 1%. High yield was down a little bit, 83 basis points, but bank loans, the diversifier, the high yield was up about 0.5%. So overall, if you take a look at what the return should be by the end of November, I mentioned another 1% or so for October, so a little bit on top of that, so we should be close to 2%. Again, this is an estimate for the overall fiscal year-to-date returns through November, and we'll bring that to you next month. So what were the returns for October? That's on the next page. The return for the month was a strong 1.34%. I'm on the page with the bar charts. And U.S. equity led the charge there. Fiscal year-to-date is now positive. It was negative the prior month. That's the middle bar was up 47 basis points, about 0.5 to 1%. And as I mentioned, November was another good month, so we're probably add another 1% on top of that. On approximations, we'll have the numbers for you next month. Page 30 shows you where we're positioned, and I'm going to turn it over to Scott.
Yeah, so we're still in the same kind of environment we were talking about last month. It's a post-easing environment. We're not getting paid to be off our normal neutral position in most asset classes. Particularly, one exception is the long-term fixed income market, where we're getting paid almost nothing to take duration risk, and that's why we have underweights in long-term bonds and in inflation protected securities, and an overweight in shorter-term securities in gray. The green box in the equities is still overweighted when we took a snapshot at the end of October. That's less today, more equal weighted across the equity classes. There's some technical reasons for that I'd like to discuss in the executive session, but the overall strategy remains the same, which is to stay pretty neutral, a slight overweight to equity, and an underweight to fixed income, particularly long-term fixed income. With that, I think we're done, Martin, unless you had anything else.
The market values on page 35, the market values of October, because it was a good month, police is now back over $34 billion, just shy of the all-time high set a few months ago back in August. We looked at the November numbers, and based on the November numbers, where we are right now, we are in estimates. Basically, it's an estimate as to whether we're at an all-time high right now. So when we bring the November numbers to you next month, we're either just shy of the all-time high, or we have set an all-time high, because, as you know, the equity markets are at an all-time high. So that makes sense. And the 10-year return is 7.5%.
We've been very flat through the first quarter, as we talked about earlier. We're well under the 7% pace. And we'd said earlier that the 17% we got last year was borrowing from the future. We're sort of proving that out so far this year. We don't expect a great deal while we sort of catch up as we go forward. That is our report for the public session, Madam Chairman, and we're happy to take any questions that you might have before you move into executive session.
Do we have any questions?
Make a motion that we go into executive session.